What is the best overall management strategy for diagonal spreads? Have you ever wondered how to effectively manage a diagonal spread in options trading? This strategy can be a great way to profit from market movements while managing risk. Let's break down the best overall management strategy for diagonal spreads. A diagonal spread involves buying a longer-term option while selling a shorter-term option of the same type, either calls or puts, with different strike prices and expiration dates. The key to managing this strategy lies in balancing time decay, price movement of the underlying asset, and making adjustments to improve profitability. First, it is essential to monitor time decay and expiration dates. The short option you sell will experience faster time decay. The goal is to let this short option expire worthless or buy it back at a profit before it expires. This way, you can hold on to the longer-term option for potential gains. Managing your position around the expiration of the short option is vital to lock in profits and reduce risk. Next, you may need to adjust strike prices and expiration dates when necessary. If the underlying asset moves significantly against your position, consider rolling the short option to a different strike price or expiration date. This adjustment can help reduce losses or capture additional premium. By making these dynamic adjustments, you can maintain a favorable risk and reward profile. It is also important to capitalize on favorable price movements. Diagonal spreads allow you to benefit from price moves beyond the short strike due to the long option. If the underlying asset moves in your favor, think about closing the spread early to realize profits or holding the long option for further upside potential. Managing the trade to capture gains while limiting exposure is key. Managing risk is another critical aspect. Know your maximum loss and profit zones before entering the trade. The maximum risk is usually limited and defined by the difference in strikes minus the net credit or debit of the spread. Understanding where the underlying price must be at expiration to maximize profit or loss will guide your management decisions. Using technical and market analysis for timing is also beneficial. Monitor implied volatility and market trends closely. Diagonal spreads can benefit from changes in time decay and volatility. Keep an eye out for volatility contractions or expansions and price patterns that might impact your position. Finally, have a clear exit strategy in mind. You can close the position by buying back the short option and selling the long option. Ideally, do this when the spread has reached a target profit or if the trade moves against your outlook. Exiting before the long option's expiration can help reduce risk and secure gains. In practical terms, managing a diagonal spread means selling the short option and letting it expire or buying it back early if profitable. You might roll the short option forward or adjust strikes if the underlying price changes significantly. Keep track of the long option's value and decide whether to hold for further gains or close the position. Always monitor time decay, volatility, and price movements to optimize your trade's outcome. By following these strategies, you can effectively manage diagonal spreads in options trading, balancing the goal of profiting from time decay on the short option while maintaining upside potential from the long option.